Welcome to this presentation from Australian tax experts, specialist tax lawyers and accountants. Today we are covering a topic that affects a significant and growing number of Australian taxpayers: ATO, offshore investigations. The idea that income held or earned overseas is beyond the reach of the Australian Taxation Office is a dangerous myth, and one that continues to cost taxpayers dearly when the ATO comes knocking. Over the past decade, the ATO's capacity to identify and investigate offshore tax non-compliance has grown dramatically. This presentation explains what the ATO can see, how it investigates offshore matters, and critically, what you should do if you have undisclosed offshore income or assets. Let's begin. This slide sets up the core problem: a persistent and dangerous gap between what many taxpayers believe about the ATO's offshore capabilities and the reality. On the left, you can see 5 of the most common misconceptions our office hears. The first: my overseas account is private, the ATO can't see it. The second: income earned before I moved to Australia doesn't need to be declared. The third: a foreign company or trust structure protects my assets from ATO scrutiny. The fourth: money transferred from overseas is not taxable in Australia. And the fifth: I've had the account for years. It's too late to do anything about it now. Every one of these statements is incorrect. And as the right panel shows, the reality is almost the opposite of what these taxpayers believe. The ATO automatically receives data on Australian residents' overseas bank accounts every year. Australian residents are taxed on their worldwide income regardless of where it was earned. Foreign company and trust structures are specifically targeted. Large overseas transfers are a major audit trigger, and voluntary disclosure remains possible, but the window is narrowing. Every one of these myths has contributed to taxpayers being assessed for very large amounts of tax, penalties and general interest charges. The ATO's offshore intelligence arsenal is built on 4 main sources of data, and together they provide a remarkably comprehensive picture of Australian taxpayers' overseas financial affairs. The first and most powerful is the Common Reporting Standard. More than 100 countries participate, and they automatically share financial account information with each other's tax authorities every year. This includes account balances, interest earned, and ownership information on overseas accounts. The second is AUSTRAC data on international wire transfers. Every transfer into or out of Australia is reported to AUSTRAC and shared with the ATO. Large or unexplained transfers are automatically flagged. The third is bilateral tax treaties. Australia has formal tax information exchange agreements with dozens of countries. The ATO can formally request specific taxpayer information from foreign tax authorities, and the request must be answered. The fourth is the ATO's own data analytics and risk profiling. The ATO's systems cross-reference declared income against overseas transfers, lifestyle expenditure, and property records to identify patterns that suggest non-compliance. The combination of these 4 sources means the ATO's offshore visibility is dramatically greater than it was even 5 years ago. Let's look at the CRS in more detail, because this is the mechanism that has most fundamentally transformed the ATO's offshore intelligence capability. Under the CRS, financial institutions in over 100 participating countries must identify account holders who are tax residents of other CRS countries and report their account information to their own tax authority. That information is then automatically shared with the account holder's country of tax residence, in this case, Australia. The data box shows exactly what the ATO receives on your overseas accounts every year: account balance, interest and dividends, your full name and address, tax identification numbers, proceeds from sale of financial assets, and gross interest and other income paid. The countries list on the lower left gives you a sense of the coverage: Singapore, Hong Kong, the United Kingdom, Switzerland, Germany, France, New Zealand, Japan, Canada, the UAE, the BVI, the Cayman Islands, and over 90 others. These are jurisdictions that were historically regarded as private for banking purposes. That is no longer the case. The practical message on the lower right is stark. If you have a bank account, investment account, or any financial interest in a CRS participating country, the ATO almost certainly already has information about it, whether you declared it or not. In addition to the CRS, the ATO receives a second powerful stream of offshore data through AUSTRAC, Australia's financial intelligence and anti-money laundering agency. The flow diagram illustrates the process. A wire transfer into or out of Australia is made. The financial institution reports it to AUSTRAC. AUSTRAC shares the complete transaction data with the ATO. The ATO then cross-references the transfer against the taxpayer's declared income and tax returns. This process is entirely automated and comprehensive. Every international wire transfer, not just large ones, is captured. What triggers closer ATO scrutiny? As shown on the lower left, large unexplained deposits from overseas, multiple smaller transfers that cumulatively appear significant, and discrepancies between the volume of transfers visible in a taxpayer's accounts and the income they have declared. The practical consequence on the lower right is significant. When the ATO identifies unexplained overseas transfers, the burden effectively falls on the taxpayer to establish the source and tax status of those funds. Silence or vague explanations do not help. They typically lead to escalation into a formal audit. The ATO's offshore investigation process follows a clear escalation pathway, and understanding each stage helps you understand why early action is so important. Stage 1 is the review letter. The ATO requests information about specific overseas accounts, transactions, or income. This is informal, but it must be taken seriously and responded to professionally. How you respond to a review letter can determine whether the matter resolves at this stage or escalates significantly. Stage 2 is formal audit. If the review response is unsatisfactory, the matter escalates. The ATO gains significantly broader powers: formal document production notices, access to Australian banking records, and treaty-based mechanisms to request information directly from foreign financial institutions. Stage 3 is the amended assessment with penalties. The ATO issues a revised tax bill for the undeclared offshore income. Administrative penalties of up to 75% apply, where there has been intentional disregard of the tax law, and general interest charges accumulate from the date the tax was originally due, which in offshore cases can mean many years of GIC on top of the underlying liability. Stage 4 is the most serious: court orders. In cases involving substantial undeclared offshore income, the ATO has applied to court for orders preventing taxpayers from leaving Australia and has obtained charges over Australian property as security for the debt. In one case handled by our office, a client's son was prevented from travelling overseas until the family's $3.5 million tax dispute was resolved. That outcome took more than a year to resolve, with our team ultimately achieving a settlement of approximately $1 million. The message is clear. The earlier an offshore issue is addressed, the more of this escalation pathway can be avoided. This slide addresses a critical and frequently misunderstood aspect of offshore tax non-compliance: how far back the ATO can go. For standard income tax shortfalls, the amendment period is 4 years. The ATO can generally go back 4 years from the most recent lodgement date. However, where the tax shortfall is greater than $2 million, or where the shortfall relates to international arrangements, an extended 6-year amendment period applies. And then there is the exception that catches many offshore taxpayers, shown in red on the right, where the ATO characterises the conduct as fraud or evasion. There is no time limit at all. The ATO can go back as many years as it considers the conduct to have occurred. The warning at the bottom of the slide is particularly important. Offshore non-compliance, failing to declare foreign income, failing to report overseas bank accounts, concealing assets in foreign structures, is frequently characterised by the ATO as evasion rather than simple error. This means taxpayers who have had undisclosed offshore interests for many years may face assessments that stretch back not 4 or 6 years, but potentially decades. Every year that passes without disclosure does not reduce the exposure. It increases it, as general interest charges continue to accumulate on the underlying liability. If you have undisclosed offshore income or assets, the single most important action you can take is to address it proactively, before the ATO identifies it independently. The penalty comparison on the left illustrates the financial stakes clearly on a $200,000 undeclared offshore income scenario. A taxpayer who makes a voluntary disclosure before the ATO commences an inquiry may face penalties of around $10,000, approximately 5% of the tax shortfall. A taxpayer who discloses after the audit commences faces $50,000, and a taxpayer characterised as having engaged in an intentional evasion faces $150,000 in penalties, plus general interest charges that may have been accumulating for many years. The timing explanation on the upper right tells you why. Under the tax law, where a voluntary disclosure is made before the ATO has opened a specific inquiry into the matter, the base penalty can be reduced by up to 80%. Once the ATO opens its inquiry, that reduction is no longer available, and there is a critical procedural point shown in the lower right. A voluntary disclosure must always be made through a professional advisor. A poorly framed disclosure, one that covers insufficient ground, is poorly worded, or inadvertently draws attention to unrelated issues, can make the situation worse rather than better. The framing, content, and presentation of a voluntary disclosure materially affects the outcome. This slide demonstrates what specialist representation can achieve in offshore matters. These are real outcomes from our office, documented in the case studies on our website. Case 1. A client with bank accounts and a business structure in Hong Kong who had not declared income there for several years. We prepared and lodged a comprehensive voluntary disclosure before the ATO had commenced any inquiry. The ATO accepted the submission and imposed no penalties at all. The outstanding tax was paid with general interest charges, but the entire penalty exposure was avoided entirely. Case 2. One of the most serious offshore matters our office has handled. A client faced a potential liability of nearly $5 million, including accumulated general interest charges, on overseas bank accounts holding more than $10 million. Our team gathered extensive evidence, engaged a network firm overseas, and built a legal case demonstrating the true source and ownership of the funds. Through sustained negotiation with the ATO, the matter was settled for approximately $1 million. Case 3. A client who brought approximately $500,000 into Australia from Singapore's Central Provident Fund. The ATO assessed the full amount as taxable income. We successfully objected, arguing the funds represented a return of contributions rather than assessable income. The tax was reduced from nearly $250,000 to approximately $3,000. These outcomes do not happen by accident. They are the product of early engagement, rigorous legal analysis, and experienced negotiation with the ATO. In each case, the outcome would have been significantly worse without specialist representation. So, should you contact Australian tax experts? If you have overseas bank accounts, investments, or assets that have not been declared to the ATO, yes. If you have received foreign income, employment income, business income, interest, dividends, or rental income, that was not included in your Australian tax return, yes. If you have an interest in a foreign company, trust, or partnership that has not been disclosed, yes. If you have transferred large sums into or out of Australia and are unsure of the tax implications, yes. If you have received an ATO letter about overseas accounts or international transactions, yes, and urgently. The message throughout this presentation has been consistent. The ATO's offshore capabilities are extensive and growing. The window for achieving the best possible outcome through voluntary disclosure is narrowing. Every year without disclosure adds to general interest charges and reduces penalty mitigation. The sooner you act, the more we can do to protect your position. Australian Tax Experts is a team of specialist tax lawyers and accountants with extensive experience in offshore tax matters. We would be delighted to have a confidential, obligation-free conversation about your situation. You can reach us at australiantaxexperts.com.au. Thank you for your time today.